Turning back to the broader markets, our next guest expects a little upside to the S&P through year-end at least, because the soft landing narrative has mostly been reflected in equity prices already. Goldman Sachs chief U.S. equity strategist David Kostin is here at Post 9, who wrote this week, "We've seen ongoing progress toward a soft landing."
We have indeed. The economic data is suggesting that, and more importantly, from an equity investor perspective, the cyclical stocks have outperformed defensive stocks by almost 12 percentage points in the last 3 months. And that would suggest to us that it's pricing, the equity market is pricing a roughly 2% GDP growth environment, which is certainly a soft landing environment by anyone's definition.
Right. Your point, though, is that in this period here, there could be some chop, at least in the data flow.
Depending on some of the inflation data, to the extent that that comes in a little hotter than expected on a near-term basis. But broadly speaking, inflation has been trending lower, and that's a key part why the Fed's likely to remain on hold. And the equity market now is on the cusp of 4,500. That's the target for the end of the year. That has been for a while, and I think that's likely to be a path that's sideways, if you will, over the next several months. Maybe a little weakness near term. Looking out 12 months, you're looking at maybe 4,700 on the index. Maybe that's 5% upside. So it's basically a sort of modest forecast in this environment.
Do you think, we'll focus on core tomorrow, but headline, people are looking for 6/10 or more. Is oil the spookiest thing about that?
So oil has certainly been volatile, and that was the big area in the second quarter results that came out roughly a month ago, and that the earnings for energy companies were down roughly 50%. Overall earnings were basically down about 3%. So that's an issue. To the extent that the commodity prices are a little bit higher, that would be a tailwind from earnings perspective in the third quarter results that'll come out in October, early part of November.
So is Jamie Dimon wrong when he says that it would be a huge mistake to assume that it will last for years, the strong economy and strong consumer?
Well, far be it from me to disagree with Jamie Dimon, but expectation, if we look out over the next several years, the probability of a recession is quite low relative to history. It's probably on average, nothing elevated in that regard. The idea of the job market continues to be relatively strong. Unemployment remains relatively low. The consumer is in a pretty strong position. And Sarah, that is 68% of the U.S. economy. So when we look at the drivers of the equity market, the single biggest important contributor to earnings growth is the GDP growth. And we're expecting the economy to continue to expand in the next year. If we look out at least a year and probably beyond that.
Interesting piece on the tape this morning looking at how housing values are affecting consumer psychology, meaning people feel like they have a backdrop, a mattress in their home. And that might keep the savings rate from spiking in the way it might have in prior cycles.
So if you think about the vectors that would drive the equity market, you've got earnings, you've got valuation, and then there's money flow. And we've seen $1 trillion move into cash, money market mutual funds this year. You've had almost no money come into the equity market. And so we think about the idea of 5.5%, almost 5.5%, earnings you get or income you get on the cash position. That's a pretty attractive alternative asset to equities. Equities have moved up, mid-teens level of returns this year. So the relative attractiveness of cash is actually pretty strong in this environment, and that is where a lot of the money has gone on the margin. And households have roughly 43% of their assets in equities. That's towards the top end of where they've been over the last 50, 60 years. So close to mid 40% kind of allocation to equities. They got 16% in bonds and 16% in cash. So those are your three major buckets of allocation: stocks, bonds, and cash. And the likelihood is you have money that goes from equities more into cash. Now, we think about allocation. It's a combination of both the change in the asset value, so equity values are up a lot, but on the margin, cash money's moving from equities into cash.